Are you tired of staring at your credit card statements, feeling like you're running in place? You are certainly not alone in this feeling. It's a common story in millions of households across the country. You make your payments diligently every month, but the balance barely seems to budge. The culprit, more often than not, is high interest. This relentless, compounding interest turns a small debt into a mountain. It siphons away your hard-earned money and keeps you tethered to the past. This cycle can feel frustrating and deeply discouraging. We've all been there, staring at a pile of bills, feeling the weight of multiple credit card statements, store cards, and maybe a personal loan. Each one has a different due date, a different interest rate, and a minimum payment that feels like you're just treading water. The numbers blur together, and the path to becoming debt-free feels impossibly far away. This was exactly where Lisa found herself. The stress was constant, a low hum of anxiety in the background of her daily life. Just when she felt most overwhelmed, buried under a mountain of complex finances, she discovered a clear path forward: a debt consolidation loan. It sounded like financial jargon at first, but as she learned more, it started to look less like a complex product and more like a lifeline. So, what exactly is a debt consolidation loan? In the simplest terms, think of it as one new loan that is specifically designed and used to pay off several of your other, smaller, and often more expensive debts. It's a strategic financial tool that allows you to combine multiple balances into a single, more manageable debt. Imagine you have 3 credit cards and a store card, each with its own balance. Instead of making 4 separate payments each month, you would take out one single loan for the total amount you owe across all 4 cards. You use the funds from this new loan to pay off each of those cards completely, closing that chapter of scattered payments. Suddenly, the chaos is gone. Instead of juggling many bills, multiple due dates, and confusing, sky-high interest rates, you simplify your financial life. You now manage just one loan. This means you have one predictable monthly payment to one lender. This simplicity is a huge benefit. It reduces the mental load and the risk of accidentally missing a payment, which can lead to late fees and damage to your credit score. You know exactly how much is due and when, every single month. This predictability makes budgeting significantly easier and puts you back in control of your cash flow. But the simplification is only half of the story. The real magic, the part that truly accelerates your journey out of debt, is the interest rate. The primary goal of a debt consolidation loan is to secure a much lower annual percentage rate, or APR, than what you're currently paying on your high-interest debts, especially credit cards. Let's be honest, credit card rates can be incredibly high. It's not uncommon to see rates of 20%, 25%, or even higher, particularly on retail store cards. When your interest rate is that high, a huge portion of your minimum payment is eaten up by interest charges alone, with very little going toward reducing the actual amount you borrowed. It's like trying to fill a bucket with a hole in it. In contrast, a consolidation loan, if you qualify, could have an interest rate in the single digits or low double digits. Imagine replacing a 24% APR with a 9% APR. The difference is monumental. With that lower rate, more of your hard-earned money in each payment goes directly toward paying down your principal balance, the actual money you owe. You're no longer just feeding the interest monster, you're actively slaying the debt itself. This means you can pay off your debt significantly faster and, crucially, pay far less in total interest over the life of the loan, saving you potentially thousands of dollars. So, where do you find these loans? You have several options. You can get these from traditional sources like banks and credit unions, or from the growing number of reputable online lenders. Banks may be a good option if you have a long-standing relationship and a strong credit profile. Credit unions are nonprofits and often offer very competitive rates and more flexible terms to their members. Online lenders have streamlined the application process, often providing quick decisions and funding, sometimes in as little as a day. It's always wise to shop around at all 3 types of institutions to see who can offer you the best terms. Most debt consolidation loans are a type of personal loan, which means they are typically unsecured. This is a key detail. Unsecured means you don't have to put up any collateral, like your house or your car, to back the loan. This reduces your risk, as your assets are not on the line if you were to default. Because there's no collateral, the lender's decision hinges almost entirely on your financial health. They'll look closely at your credit score, your credit history, and your income to assess your ability to repay the loan. A higher credit score and a stable income will give you the best chance of approval and unlock the most favorable interest rates. For Lisa, this was a game changer. She had 2 credit cards with a combined balance of $8,000 and an average interest rate of 22%. She was approved for an $8,000 personal loan at 9% APR with a 3-year term. In one swift move, the funds from her new loan wiped out both card balances. The chaos of 2 payments became the clarity of one. She had effectively united all her resources to fight a single, much weaker opponent, a much lower interest rate. She now had a fixed monthly payment and a definite end date for her debt. For the first time in years, she could see the finish line. That is the power of debt consolidation. Understanding how consolidation works demystifies the process. First, check your credit score. Lenders use it to gauge reliability. Then shop around. Compare offers from banks, credit unions, and online platforms. Focus on APR for the full cost picture. Pre-qualify without a credit hit. When you find savings and solid terms, apply. Be ready with ID, income docs, and current statements. If approved, funds go to you or your creditors directly. Use the loan immediately to zero out high-interest cards. Replace multiple expensive debts with one affordable loan. Now, make that single payment on time until it's gone. This is a moment of triumph. Simple, structured, and doable. Lisa had $8,000 split across 2 cards at an average 19%. She paid $300 per month. On that path, it would take years to clear the debt. She'd pay thousands in interest, money for savings, vacations, or investing. That's the long, slow, expensive slog. After researching, she found an $8,000 personal loan at 8% with a fixed 4-year term. Payment about $190. Improving monthly cash flow by $110. Old plan over 4 years, roughly $3,400 interest, about $11,400 total. New plan, about $1,350 interest, $9,350 total, over $2,000 saved. One path fights friction. The other is smoother, faster, cheaper, with a clear finish line in 4 years. The headline benefit is a lower interest rate, the engine of this strategy. Shifting from 22% to, say, 9% is a game changer. Every dollar works harder against principal, accelerating your exit. It can save hundreds or thousands over the term. One payment and one balance reduce clutter, stress, and missed payment risk. Fixed terms give a definitive end date, a powerful motivator. Paying cards to zero lowers utilization and can boost your credit score. The new loan appears on your report, but lowered revolving balances often help more. Simplicity, savings, and a finish line. Financial calm you can feel. Taking the step to consolidate your debt is a significant and empowering decision. It feels like you're finally grabbing the steering wheel and taking control of your financial journey. A consolidation loan can be an incredibly powerful tool, simplifying your payments and potentially saving you a great deal of money. But it's crucial to approach it with your eyes wide open. This is a financial strategy, not a magic wand. Waving it won't make your debt disappear. It simply reshapes it into a more manageable form. The real magic happens when you understand the potential pitfalls and navigate them wisely. Without a clear understanding of the risks, you could inadvertently find yourself in a situation that's no better, or even worse, than where you started. So, let's walk through the most critical risks you must understand to ensure your consolidation journey is a successful one, leading you to true financial freedom. The first hurdle to be aware of is the cost of the loan itself, specifically the fees. The most common one you'll encounter is the origination fee. This is a one-time charge the lender takes for processing your loan, typically calculated as a percentage of the total loan amount. Let's say you need exactly $8,000 to pay off all your credit cards. If the lender charges a 5% origination fee, that's $400. This fee is usually deducted directly from your loan proceeds. So, instead of receiving the full $8,000, you might only get $7,600 deposited into your account. If you hadn't accounted for this, you'd be left with a $400 shortfall, unable to pay off your debts completely. Always ask if the fee is deducted from the principal or if you need to borrow more to cover it. Also, keep an eye out for other potential costs, like prepayment penalties, which charge you for paying off the loan early, or hefty late payment fees. These details are buried in the fine print, and understanding them is key to calculating the true cost of your loan. Next, let's talk about the loan term. Lenders will often advertise temptingly low monthly payments, achieved by stretching the loan out over a longer period, say 5 or 7 years instead of 3. This can feel like a lifeline when your monthly budget is tight. However, this is a critical trade-off. A longer term, even at a lower interest rate than your credit cards, can mean you end up paying significantly more in total interest over the life of the loan. Think about it. Every extra month you're making a payment is another month the lender is collecting interest from you. The goal of consolidation is to save money, not just to lower your immediate monthly cash crunch. Before you commit, you have to do the math. Use an online loan amortization calculator. Plug in the loan amount, the interest rate, and then compare different terms. Look at the difference in the total interest paid between a 3-year term and a 5-year term. You might be shocked at how much that lower monthly payment actually costs you in the long run. Your mission is to find the sweet spot, the shortest possible loan term that still offers a monthly payment you can comfortably afford. This ensures you get out of debt faster and maximize your overall savings. Don't let the allure of a low payment distract you from the ultimate goal of paying less. Now we come to what is, without a doubt, the single biggest danger of debt consolidation: spending creep. After you've paid off all those high-interest credit cards with your new loan, you'll suddenly have several cards with zero balances. It can feel like you've been given a clean slate and a huge amount of available credit. The temptation to start using those cards again, for a small purchase here, a little treat there, is immense. This is a psychological trap. If you fall back into old spending habits, you won't have eliminated your debt. You'll have just doubled it. You'll be stuck with the new consolidation loan payment, a growing pile of new credit card debt. This is how a well-intentioned financial move can spiral into a catastrophe. To prevent this, you must commit to disciplined financial habits. You even sign the loan papers. The solution isn't just willpower, it's a concrete plan. Create a detailed, realistic budget that accounts for your new loan payment and forces you to live within your means. Consider a spending freeze for the first few months. Some people choose to close their old credit card accounts to remove the temptation entirely, while others prefer to keep 1 or 2 open for emergencies and to maintain the length of their credit history. If you keep them, physically put them away. Lock them in a safe or give them to a trusted family member. The goal is to build a fortress around your finances so that spending creep has no way in. Another major risk lies in the type of loan you choose, secured versus unsecured. You might see offers for secured loans with much lower interest rates. These loans are secured because you pledge an asset as collateral, most commonly your car or your home. The lower rate is offered because the lender is taking on less risk. If you can't pay, they have a direct path to recoup their money. But in exchange for that lower rate, you are taking on a much higher personal risk. Think about the worst-case scenario. If you take out an unsecured personal loan and lose your job, you'll have to deal with collections and a damaged credit score, a serious financial problem. But if you default on a secured loan, the consequences are life-altering. The lender can legally seize your collateral. You could lose your car, which you might need to get to work, or even face foreclosure on your home. You are trading unsecured debt, like credit cards, for a debt that puts your essential assets on the line. Unless you are absolutely confident in your job stability and have a robust emergency fund, it's often wiser to opt for a slightly higher rate unsecured loan and protect your home and transportation. Finally, understand the risks, choose your loan terms wisely, and most importantly, protect yourself with firm, disciplined spending boundaries. A consolidation loan is a second chance, a powerful reset button. By navigating these potential hazards with awareness and a solid plan, you can ensure it becomes the launching pad for your financial recovery, not another setback. Step 1. Compare interest rates. Focus on APR. Get quotes from at least 3 to 5 lenders. Use soft pull pre-qualification to preview rates without hurting your score. Ask about origination fees, prepayment penalties, and late fees. Note the monthly payment and total loan length. Read before signing. Compare apples to apples. Pick a term aligned with your budget and goals. Shorter terms cost less overall. Longer terms ease the monthly load. Balance savings with affordability. Compare APRs, scrutinize fees, choose the right term, then pick the loan that fits your life. When you're ready to shop, know where to look. Start with your bank. Relationships can yield competitive rates. Credit unions often offer lower rates and fewer fees. Membership may be easier than you think, and worth it. Online lenders. Quick applications, lower overhead, instant pre-quals. Use comparison sites to cast a wide net. Peer-to-peer platforms can be competitive, especially for unique borrower profiles. Explore all 4: banks, credit unions, online lenders, and P2P. Compare to choose the best offer for your situation. You understand the problem, and you've seen the potential of a solution like debt consolidation. You've absorbed the concepts, perhaps run some preliminary numbers in your head, and weighed the potential benefits against the risks. But here's the truth. All the knowledge in the world is just potential energy. It's a map sitting on a table. It's the moment you decide to take the first step that you begin the journey and transform that potential into real, tangible change. Knowledge matters, but it is action that truly changes outcomes. The good news is that this journey doesn't start with a giant, intimidating leap. It starts with a few small, manageable steps that you can take right now. So, let's begin with the first concrete action: creating your master debt list. This isn't just a list, it's your strategic dashboard. It's where you take all those scattered numbers and anxieties and organize them into a clear, objective picture. Grab a notebook, open a spreadsheet, or use a notes app on your phone. We're going to create 4 columns. In the first column, list the name of each creditor, every credit card, personal loan, medical bill, or store card you owe money on. In the second column, write down the exact current balance for each one. You can find this on your most recent statement or by logging into your online account. In the third, and arguably most important column, enter the annual percentage rate, or APR. This is the number that dictates how quickly your debt grows. Finally, in the fourth column, list the minimum monthly payment required for each debt. Once you have this complete list, you have a powerful tool. You can now see your entire debt landscape in one place. You can even organize it to see different strategies. For example, sorting by the highest APR is the foundation of the debt avalanche method, where you save the most on interest. Sorting by the smallest balance is the debt snowball method, which uses quick wins to build momentum. Consolidation is a third path, but creating this list is the non-negotiable first step for any approach. This document is your starting point, your ground zero. Next, let's check your credit score. Your score is a key factor that lenders use to determine if they will offer you a loan and at what interest rate. A higher score generally unlocks better offers with lower APRs, which is the entire goal of consolidation. You can get your score for free from many credit card providers, banking apps, or dedicated credit monitoring services. Don't worry, checking your own score like this is a soft inquiry and has zero impact on your credit rating. What you're looking for is not just the 3-digit number, but also the factors influencing it. Is your credit utilization high? That's something consolidation can directly improve. Gathering your statements and checking your score are 2 powerful actions you can complete in less than half an hour. In the time it takes to watch a TV show, you can build the entire foundation for your debt-free plan. Now that you have your debt list and your credit score, it's time for the third step: gathering intelligence. The goal is to get at least 3 pre-qualified offers for a debt consolidation loan. This is crucial for comparison shopping. We recommend checking with 3 different types of lenders to get a broad view of your options. First, try a credit union. They are member-owned and often offer competitive rates, especially if you're already a member. Second, explore an online lender. These digital-first companies can be fast and convenient, with streamlined application processes. And third, check with your primary bank. Your existing relationship with them might give you access to preferential rates or terms. The key here is to look for pre-qualification or check your rate options. This process uses a soft credit inquiry, just like when you checked your own score, so it won't affect your credit. You are simply window shopping for the best possible deal. There is no risk, no commitment, just information. You're gathering data to make an informed decision, not signing any contracts. Once you have a few offers, it's time to compare them, not just to each other, but to your current situation. Create a new section in your spreadsheet. For each offer, note the APR, the proposed monthly payment, and the loan term, which is how long you'll be paying. Pay close attention to the APR. This is the total cost of borrowing, including interest and some fees. Is it lower than the APR of the debts on your master list? Also, look for any fees. An origination fee, for example, is a percentage of the loan amount deducted up front. A 3% fee on a $20,000 loan is $600. You must factor this cost in to see if the consolidation is still a net win. Now, compare the total cost. For each offer, multiply the new monthly payment by the number of months in the term. This gives you the total amount you'll pay back over the life of the loan. How does this number compare to what you would pay by sticking with your current credit cards? You might be genuinely surprised at the potential savings, which could amount to thousands of dollars. This is the moment where the abstract idea of financial freedom starts to feel real. You can rewrite your financial story. It's not just about the numbers, it's about simplifying your life. Imagine replacing a dozen different due dates, interest rates, and logins with one single predictable payment. This clarity frees up mental energy that you're currently spending just trying to keep up. You can lower your overall interest rate, which means more of your money goes toward the principal balance, not to the lenders. Most importantly, you create a clear, defined path to becoming debt-free. A consolidation loan has a finish line. You know exactly when your final payment will be made. That certainty is one of the most powerful motivators you can have. It all starts with that simple, conscious decision to act. The path from debt to financial peace of mind is paved with small, intentional actions, not just wishful thinking. So don't wait for the perfect time. The perfect time is now. Take 30 minutes today. List your debts with their balances and rates. Check your credit score. Then get a few pre-qualified quotes to see what's possible. See the real numbers for yourself. This isn't about pressure. It's about empowerment. It's about giving yourself the data you need to make the best choice for your future.